questions from the group here? Yes.
Yeah. How do you evaluate exits? Your exit strategy is a chance of making some money out of the deal where the CEO, the owner of the company, has no interest in selling and leaving the company because he wants money to make the business grow.
So the question is, in case you didn't hear it back, how does an investor evaluate the exit strategy if the entrepreneur has no interest in selling his or her company downstream? Softball question, got it?
Well, we tend to call that a lifestyle company, and we have no interest in investing in such a company.
This gets back to my first statement, which is as an angel investor, we look at how we make money. So if there's no exit, there's no way for us to make money.
Okay, question over here.
Kind of in the same vein, if I come to you looking for angel money, and it's a business that, for one reason or another, we know is going to take multiple rounds of venture down the line, how do you view that, like that, like almost what's the relationship with VC these days?
Did everybody hear that question? Yep, okay.
There's a reality to your situation where you say I'm going to need multiple rounds. First of all, if you're getting up over clearly you're getting up to 50 million, it's very dangerous territory for angel investors. Even at 20 million, sometimes that's a challenge, and I'll tell you why. Every successful round, every successful new investor comes in VC, more or less has the opportunity to rewrite the terms of the deal. So the more rounds that occur, the more the risk that the underlying initial early stage investors will be forced into a lower valuation or will have to give up their preferences and the terms of their deal. In fact, if the company goes along, it's raising more money, it's getting a higher value, and it has a down round, meaning the valuation from the prior round has dropped. The investing entity, the one who's leading that round, will tend to rewrite the terms and what they call crunch down, or just dilute down all the earlier stage investors with all that risk. So that's one of the main reasons that a company needs many rounds is not too aggressive.
But almost every company's going to need more money, right? And so how do you think about that risk in terms, the risk of the next?
The key is, why does the company get a down round? And the reason is that they didn't hit the milestone, they haven't delivered on a product, they haven't delivered on customers, all kinds of things fail. So now they're out of money, and they are not even going to get the valuation that the last round did. So what we try to do, Bill, is, and I think people recognize this, is to see if that company has the chutzpah, really, to get to a break-even situation at the end of that round. That round, our belief is to get out about 18 months. A lot of people raise money for 12 months, I might believe, and a lot of our investors believe is we're going to have to fund this company for 18 months, otherwise we're kidding ourselves. They're going to run out of money quickly. It's got a 6-month time period to raise new money, so what are we going to do? Give them 6 months to try to get going and then have to turn around and start raising money where they lose all their focus so they can not go out of business or be insolvent at the end of 12 months. So we really believe that they need 12 months to grant, and then they're going to spend 4 to 6 months for a new round, and hopefully they're break even or slight positive cash flow at the end of 18 months. That's the scenario, at least I like to see.
So Anna, I'd like you to pile in on this one a little bit, and in particular, if you would explain the thinking when the initial money went into Twitter. Was the expectation that it was going to have to raise so much money before it actually had a business model, or what was the thinking behind writing a check for something like Twitter?
Well, Twitter was what we call forward fumble. So our original investment was in a company called Odeo that did basically podcasts. And when Apple decided to include podcasts in iTunes, then we decided we were out of business. And Evan Williams offered to give us our money back, at which point we said, well, that's not the way this is supposed to work. A lot of investors actually took their money out at that point. We just told him to put it into his next thing. He said, well, there's this thing called Twitter. It's 140 characters. It's kind of this micro-blogging concept. And we were like, well, we've lost our money for sure at this point. And so, that doesn't really go into our thinking. For us, it was, what I discovered is actually, people are actually looking at portfolio as deal flow. And so they'll go through our company's webpage, and I was actually told by one of our company CEOs that they got a call from an analyst at a venture capital firm when he asked where they found this company. The person admitted that they were just trolling our website and our company portfolio. And so we've embraced this concept of there are VCs that are going to do follow-on financing. If our CEOs want to go down that route, they believe they're the thunder lizards, then we're all for it, and we will help them raise their future rounds of financing from really great VC firms. But then again, we have these companies who decide that they don't want to go down that route, and we're supportive of that as well. We do this drip feed model where we continue to give them an infusion of capital when they want it, and then they try to get to breakeven as quickly as possible. Because I think this 18 to 24 month period of raising your enough capital to get you through 18 to 24 months is absolutely critical these days, because the VCs are really sort of make their decisions.
Now, I'm just trying to get the matrix. We got forward fumbles, we got thunder lizards, we got
It's a whole language.
whatever works, right? Okay. Mixing metaphors. Okay, next question. Any, yes?
Well, I'm sure the answer is it depends, but you mentioned already, talking to customers and getting some feedback, maybe having a product for the customer that maybe I should pay money for. At what point would you suggest, or what is your preference when companies come to you? How far along should it be? I mean, is it, I just have this idea, but I haven't talked? Is it I have talked, I've bootstrapped it a little bit, I have a product, but I don't know if it's the right one? Use a whole spectrum of how long you kind of bootstrap and develop in your own time before you finally say, hey, if I had X amount of dollars, I could do new activities.
Okay, so the question is, when are you ready to approach an angel investor?
Sure.
Is that fair?
Fair.
All right. Anybody?
I think you should approach an angel or more, or the circle of advisors, or that type of thing, as soon as you get access to something. That doesn't mean you're raising money. I mean, what you want to do is get some smart outside people to help you, coagulate your company before you bring it in, or help you find your fit. So, I mean, yes, it depends, but I mean, the best thing you could do in terms of valuation and everything else is get as far as you can first. Now things have changed a lot in software. You can get pretty far. You can put up a website, you can beta test it, you can get lots of customer feedback now. So the further you are along, the further you verify that what they used to say, the dogs eat the dog food, that the customers want this, that the customers will pay for it, the better. But approaching angels early, not as a funding vehicle, but as a advisor vehicle or helping you refine it, I would recommend you do that as soon as possible, because like you approach me and I work with you for 2 or 3 months before I bring you in to the angel group, you have an advantage.
Any other? I mean, I would endorse that. It's never too early, but you do not want to start broadcasting the business plan out there, until you get enough trusted feedback.
VCs will not sign an NDA, we will not sign an NDA, so don't tell us anything that you don't want out, and almost everything gets out when you go to a group.
Okay, so I've been given time to get one more question for this panel before we do our next thing. Yes?
I don't know, but
From the back?
oh, sorry. Thanks. As an angel group, do you have a life of a fund or a life of the investment like VCs? And then as a follow-on question, if it looks like the value of the company is going to be much greater at the end of, say, a 5-year period, is it ever the case that the investor would wait for a liquidation event in order to capture those additional potential liquidation upside?
I'm not sure I understood the second part of your question. Anybody understand? Okay. Ask that second part one more time.
Sure. So if you have a life of a fund, then
Not that part.
so at the end of 5 years, say, if there's the possibility for a significant increase in the valuation of the company,
6 months down the line, there's a great likelihood for a significant market share increase, then does a fund or an angel group ever wait for, past the duration of the fund, that 5-year